Year was great. Today's a beautiful day. It's a day we never seen before and a day we'll never ever see again. You already know what's going on. It's your boy Eddie One Take Man. We here. We're trading for the trappers. You already know. We in the Discord right now. Feel free to tap in. I'm definitely gonna leave a link in the description of this video. And on Sundays we do market recap just to see what the market has done for the previous week and to get ready for this week. So give me a second here. All right. So the purpose of today's call, this market recap call, is basically you want to know what happened in the previous weeks to get ahead of the market and with a clear game plan. Now, what we do on this call is review last week's moves on last week's key moves on gold indices and forex. We're going to identify critical levels for the week ahead, and we're going to plan high probability setups. All right, so let's get right to it. First thing we're gonna look at is, and this call is being recorded, so I'm going to make sure that anybody that didn't see it gets the recording. I'll put a section in the Discord. All right, so this is gonna be a quick call, nothing crazy. Again, just to get ahead for this week. But I'm looking at Bitcoin right now. Bitcoin is at the all-time high. Now, let me erase this real quick so I can just start with a clean chart, because we want to follow the same process every single time to make sure that we are getting these high probability setups. Now, I can see overall Bitcoin is in an uptrend. Just look at where it started back here, like the 2008 area. I know Bitcoin came out 2008. Let me move this out of the way. Perfect. All right, Bitcoin came out 2008. This says 2020. That's as far back as it is going to go right now. But Bitcoin was down here, 4,000, obviously. Had a spike up, came back down. Never went below the lowest point, which was like 4,000. And it's been going up ever since, following a bullish market structure. So if we look at what's relevant right now, I'm on the daily time frame. That's important to note because you want to start with a higher time frame to get the overall bias of where the market is going. So we can see this market is obviously going up. Now, this looks like a really good instrument or asset to put your money into. But since we see it going up and we got a clear direction of where the market is going, we want to get in for this buy, but we want to wait until it comes back down. So let's identify some key levels on Bitcoin. All right. So I could see before this break to the upside, this was the last high the price made before coming back down. And that price is, bear with me. That price is $109,000, 312, and then it dropped down back to $74,393.46. Now, along the time of it going up, I see the market created disproportion or gaps in the market where price is only going in one direction and it's not balanced out. So I can see that the price created a gap going up right here, and I'm gonna identify that gap with a rectangular box, keeping it very simple, not to overcomplicate it. Boom, we have structure. The market went up, it fell, it traded a little bit higher, taking out the liquidity, because liquidity sits at highs and lows in price. So This price came up and it made a high, and this wick or this shadow traded a little bit higher, and then the algorithm kicked in and the price started to fall back. So Bitcoin started to drop, and all it did was drop for people to get in at a better price. The banks don't want to buy it up here at 108,000, and they don't want to buy it up here again at 108 or 109,000. If the bank could buy it at 109,000 versus 74,000, they would get it at 74,000. So you see the market has a reaction at this $74,000, $80,000 price. Also, we could grab fibs just to see this last low before the market took off, and then this last body high before the market starts coming back down. I can draw fibs on that just to see if that made any sense, and we can see it did. When it popped up and it came back down, it was at a 50% discount, then it was at a 60% discount, and then it even gave you a 70% discount from when it initially went up right here. So if you could get Bitcoin at $100, right, and then it was, let's just, for example, if it was $100 and you seen the price coming down and you could get it 70% off, that means you would pay $30 for what people paid $100 for. So when the price goes up, you're gonna make money. Now that structure looks beautiful. So we have the price. It was resisting at this level. It wasn't breaking through all the way until last week. Yes, last week. So price for Bitcoin is at an all-time high, and it's not coming back down right now. So there's nowhere for me to like put any structure, but I do see a gap that the market created, and that is right here. So if it does come back down, it is most likely going to come back down in that gap for a better price. And I also see other gaps down here. So Bitcoin is going up. Bitcoin is a good investment, even if you're not trading. If you just want to park your money in Bitcoin, that's cool. Instead of just leaving it in your bank account where it's not really appreciating. This is the way you can have your money work for you, is purchasing Bitcoin just a little bit here and there, $10 here, $5 there, and watch it accumulate. But Bitcoin is definitely going to 200,000, 300,000 per coin. So, all right, cool. That's Bitcoin. Bitcoin broke some key levels. It's at an all-time high. This is amazing right here. The news and everything is going to be going crazy tomorrow because it's about to be at 120,000. So that's Bitcoin. We're going to watch that for the rest of the week. As of right now, this is the current price. We see it at 100, and we're going to mark this here. Boom. Current price, we'll make it blue so we know that that's where we started looking at it. And cool, that's Bitcoin. Now let's look at gold, my favorite, and then I'm gonna end off with USD JPY or anything else somebody recommends to trade. But let's look at gold. Let me save this first and then delete everything. So again, same procedure, same process, top-down analysis. Start with the higher time frames. Start on the daily time frame. And on the daily time frame, you want to identify the bias of the market. The bias meaning you think overall it's going up or overall it's going down. So the first thing that I want to do is mark off some significant prices, like some key level highs and lows, like this. So I have a low here, and then the price shoots all the way up here. So this is the current range that the price is in right now. I could also see that this was a high at one point in time, and then price broke the structure going to the upside with a body candle. So that created disproportion in the market. And we can see here the price tried to come back and fill some of this gap, which it did a little bit, gave us some wicks in there, and then took back off. The price broke above this high right here with some wicks, as we can see right there. And then the algorithm kicked in and the price started falling back down. So when it fell back down, why did it stop right here? Why didn't it keep falling down? Because there was a gap in the market going up, which is right here. And we can see that once the price created this disproportion in the market, it went up and it started coming down. It wicked and it touched this level a bunch of times, and it created a higher high, higher than this, as we can see. I'll notate it. It gets closed above, and then the algorithm kicks in. Price comes back down for a better price into a better area for market makers or the banks to buy into it, and you can see they take it higher than this price. So the structure of the market is going to the upside. Now, once this high takes out this high, like they took out the liquidity or traded above it, threw a wick above it, whatever, the algorithm is going to kick in and the price is going to reverse to make the people who don't understand what's going on panic. So if you already thought the market was going up here and you see it starting to come down here, you're going to get comfortable in the sells. But they were just taking out lows at the bottom and starting to go back up. So we can see this level right here, this structure level gets held. The price has not traded below this structure level. Traded into it a little bit, again closing some of this gap, but they never broke below this low here. And I'm gonna mark that off with that. So we can see they never took out this low. They came right down to it, but never took it out. Never traded past it, never liquidated that price. Okay. Now, if I want to grab fibs too, this is the last low before this price breaks structure and continues to make this move up before coming down. So I'm going to grab fibs just to identify how much the price came down. All right. Look at that. The price went up all the way here, and then it fell back down, gave you a 50% discount, 60% discount, 70% discount, and then pop back up. So if you could buy something at $0, you basically kind of, or let's say you buy something at $1, right, and it goes up to $100, you would have made a lot of money, right? And let's say it's at $100, you wouldn't want to buy it at $100. You would want to wait until it comes back down and has a 70% discount. So you buy it for $30. If you couldn't buy it for $1, just wait. It'll come back. You got it for $30, and now the price is starting to go to these targets up here. This all-time high is our ultimate target because that is where liquidity sits. That is where the money lies, above highs and above lows. So now, excuse my charts. My mouse is still acting crazy. All right. So overall on this, I see the price is not, it didn't take out this low. Let me take out this fib. So the price didn't take out this low with this move, and then they pushed up, taking out this high. Right there. I can even put it through. It's cool. So they took out this high and traded above it with a body close. So that made the algorithm kick in. And it traded back into these gaps. There was like a gap here. I don't want to clutter my charts up too much, but I'll still identify the gap. All right, right here is the gap, and we can see how price like traded back into it. There is another gap down here, but that's on a smaller time frame. So what I'll do is just erase this for now, and we can see that the price just traded back into it and is now starting to push back up. If I want to grab my fibs from this last low to this last high right here before it starts coming back down, I can see again the price went up to 100%, came down, gave me a 50% discount, 60% discount, 70% discount. This even gave me an 80% discount before starting to push back up. So I'm interested in buying this because I think overall it's gonna go up to these targets, and my targets being the highs and the lows. This is my target right here. I'm gonna identify this with a green candle, a green ray being the target. My red lines are the highs that have already been hit and taken out. Okay, boom. Now, if I want to get in on this for the buy to go up, I don't want to buy it up here where it is now. I want to get in on this gap. I want to see how the market fills this gap, and this is a 1 hour chart that we're dropping down to. I'm gonna extend this high that got taken out. It got taken out right here, and then you had a disproportionate candle trade above it, and then the price broke back into this structure. So if I look to the left, these big boxes that I have drawn, they came from the from the daily time frame, and then I'm going to draw out some smaller time frame gaps where the price, look at that. I'm going to change the color on it too to make it easier to identify. All right, so the price traded down and it created this gap in the market to the downside, and that's signified by this horizontal box and also by this circle. There was a disproportion in price, and we can see how the price tried to come up here, tried to retest it here, tried to retest it here, but never traded above it. And once it finally did here, it just traded right back into it. So which direction is this price gonna go in? Let's drop down to if I'm on the hour, I want to look for liquidity. So I can see that this is the highest price that it was on Friday, and the price got traded above, so this liquidity got taken out, and then you have an engulfing candle going to the downside. So the next target would be to fill in some of this gap or come down here and take out this daily low from Friday. So that is a target. If they go to the downside, they're just gonna retrace and go back up. And then there's also a low here and the lowest price of the day here. So if they do want to come back down, they could come back down to close up some of these gaps before going up here to take out these highs. For right now, it is, let me go down to the 15. For right now, they are respecting, let me see, price broke structure, but I want to see how the price plays here. They filled in this gap, this engulfing candle went up, took out these highs, and they created a gap here, and this gap here got filled, and we want to see how they react to it. Maybe they are going to retest it and then drop like this, or just continue to drop. But either way, for the day, I think this price is going to be bearish because the banks don't want to buy it up here. See, this price is high compared to down here and compared to down here. The banks don't want to buy it at a high price. They want to come back down before going in their motion. So we're looking for, if we're trading tomorrow, let me see, was it 12 o'clock yet? No, it's not 12 o'clock yet. I'm going to do some videos to talk about like the different specific times to trade and things like that. But this is just to recap what happened the previous weeks. Sunday, Monday, the price dropped down, created a low, and then traded higher, taking out the daily high. Then Tuesday, it dropped down, took out the daily lows, didn't take out the daily highs yet, and then they set daily lows here, excuse me. Then Tuesday into Wednesday, they traded below those daily lows. So you can see how like the market is working in those waves. But a low there gets taken out. The banks made money. A low there, the banks take it out. They made money. A low here, the banks take it out. They made money. And then you can see how the price doesn't go lower, right? It traded below this, but it doesn't go lower than that because there are now people who the banks have made comfortable for the sell. People, especially seeing moves like this, they missed it or whatever, they're gonna start selling, and they're gonna start selling at the worst time. So they're starting to sell here when we, on the other hand, think like the banks, and we see that the price is not going below this. Also, it's at a significant gap, and we would be looking for the reversal, which we did. We caught this move last week, and you can see on the way back up, all the highs that the market was setting got taken out. That's how they make their money. The bank set some highs, the market took it out right there. That's how they make their money. The market set highs, the bank took it out. That's how they make their money. So that's why we look for the highs and lows, and that's why those are our targets, because that's where the money is. So I think this is going to be going to the downside because of this structure already. Unless if it doesn't close below here, then it's going to continue to go up. But they already took out the daily highs from Friday, so the algorithm kicked in, and it's going to the downside. We may just see a retracement before it goes back down, and it'll look something like this. From this high to this low, boom. This would be the trade for probably London session, but we would wait for the price to go back to at least 50%, 60%, 70%. Sometimes it'll even give you an 80% discount. But these two areas, the 50 and the 60, is our golden zone. So even if the price goes up here, we're going to kind of wait until we see movements in the 50 and 60 zone to take it down like that. So let me put the short position on here and calculate what this trade might possibly be like. Above that high, it's a little, well, you might want to manage your risk on here. 40 pip stop loss, that's above that high, but your target is 200 pips. So what does that mean? That means that if we were to take this trade and we were to take it on a standard, we would be risking $470 to make 2,000, which is really good. Or if you think about it in the smallest terms, if you had $100 account and you were risking a 0.01, which is the smallest unit you can purchase, or the smallest order you can put in, which is like 1,000 units. But every time the price moves, you would make 10 cents, right? So let's just say a 40 pip stop loss, you would be risking $4 to make $20, which in the real world, I would do that because that is a risk to reward 4 times. So whatever you're putting in, you're risking, you're gonna make 4 times that amount. So this would be a good trade. I would wait for this, but we won't know until London session. So that's the market recap for Bitcoin and gold so far. And then the last but not least, let's do UJ. USD JPY, the US dollar versus the Japanese yen. I started marking this up already, but again, just so we keep our jump shots fluent, we want to practice the process. The money is directly attached to the process. All right, let me save that. And then, let me go back to gold real quick so we can mark down the price that we started looking at it at. Definitely want to take note on that. And then we're going to do UJ. So for gold, let me mark down this price. Right here is where we're starting to look at the price, or leaving off from looking at it. Boom, boom. That's gold. All right, 33.53. So again, we starting to see that push up because this price, this last low before the price took out these highs, got liquidated. The price traded below it, so the algorithm kicked in, and now it should retrace to fill in some of this gap before coming back down. So that's gold. That blue line is where we are looking at it at. Bitcoin, same thing. Did I save Bitcoin? Oh yeah, I did. Okay, it's about 15 minutes. But yeah, Bitcoin, same thing. This is the price we started looking at it at, and now UJ. All right, USD JPY. Again, the process is what pays you. So most important thing, you want to start on a daily. If you really want to get surgical, let's get surgical with USD JPY. All right, higher time frames always give you a better direction of where the overall market is going. So what does that mean? You can start on a daily, but if you want like real true direction, you can look at the monthly and the weekly. So let's look at the monthly, right? We can see that the all-time, damn, JPY was high as hell. But this is a high right here. This is the highest that the price was at a certain period of time before it started dropping. So that was 2004, July. Wow, last year. Look at where JPY was compared to this year, right? So this is literally 1 year ago. July 1st, 2024. The price was up here and it started dropping down, right? And then it went back up. Why did it go back up and stop right here? Why did it not just keep going up? Because they had to make a decision in here, right? And I'm just going to draw this out. I could make it a little cleaner, but I just want you to see what I see in terms of a gap, right? So there was a gap in price from here to here, and look at how precisely to the T this price comes here and it rejects and it trades lower, taking out this candle right here was the liquidity, because look at how it took out this high and this high, and this was the move up that filled the gap. So when it traded down, it took the liquidity out. They took the liquidity out from here previously too. But overall, USD JPY was coming down, and the reason why this price stopped right here at this 16195 is because if we look to the left, there was a high here that it didn't take out, but it took out this high here. So you can see once it took out the high, make it red so we know that that's a high that's taken out. Once it took out the high, the algorithm kicked in and it started trading down to maybe throw people off who don't know what's going on and make them think it's going to go in a sell. And then you can see they pop back up and just create a bunch of panic so the average person doesn't know what's going on. But overall, this price is still going up as of 2012. So was I looking at it wrong? All right, nah. Last year. Oh yeah, we were looking at it right there. Yeah, so 2012, this price has been going up, and then you can see like market structure is. I'll break it down real quick just so we can understand what we're looking at. This is market structure. If you want to trade, then you have to understand market structure. Market structure is the most important thing when it comes to trading, because if you don't know where the market is going, you are going to lose money. Now, market structure consists of two things. If someone's like, yo, what is market structure? It only consists of two things, to keep it simple, 1 and 2. We're going to go over the first thing very simply and then show you how it applies onto the charts starting from down here. So market structure is this. Liquidity is the first thing that market structure entails. The one out of two things is liquidity first. Now, what is liquidity? Liquidity is literally anybody pressing buy or sell in the market. Anybody who's a market participant, whether they're a retail trader, an institutional trader, whether they're a hedge fund, it doesn't matter who you are. If you are pressing buy and sell in this market, you are liquidity. We are liquidity. Everyone that presses buy or sell in the market is liquidity. So how do you identify liquidity when it comes to market structure? Liquidity sits at the highs and the lows. Why? Because that is where people are placing orders. For example, when the price rallies up here and a high gets created here, you have people who are starting to sell. They put stop losses in up here. They put pending orders. They put a bunch of things up here. So that's why liquidity is up there. Now the price will trade back down and create a low. And this is also liquidity right here. Right? This low is liquidity, because remember, at the highs and lows is where liquidity is. Now this price comes down and creates liquidity, but it doesn't take out the previous low. What it does is it goes up and it trades above the previous high. So now this market is starting to form a bullish structure. Higher highs, higher lows, higher highs, higher lows. But the one thing you have to understand about liquidity is that if there were stop losses and pending orders and buy stops, sell stops, things like that above this high, when the price comes back down, that is where their target is going to be, because there are orders sitting above here. If the banks buy it down here, they want to drive it up. Now, when they drive it up, right, they've made their money here, and they're starting to cash out here. The average person is going to chase this trade going up and start buying here, right? When they start buying here, the algorithm kicks in because it just hit a high, and the price is going to start to retrace, right? So they're buying, they're losing their money, it's hitting their stop loss. They think it's going to keep going up, they keep selling, but they weren't patient enough to wait for the price to come back down. So liquidity is created here, and then the price trades higher. Same thing for a downtrend. I'll keep it real simple so we can just go right into disproportion, which is number 2. But liquidity to the downside would look like this. Lower lows, lower highs, lower lows, lower highs. All right. Price comes down, creates a low. And this low right here would be liquidity. Now the average person seeing this big move, right? For example, I'll show you on the charts. We'll get to it. It creates this low here, that's liquidity, and then it trades up, but not as high as this. So the banks don't want to sell down here, they want to get it at a better price. They want to get it at a premium. So when they have it at a premium, they can make more money, right? And they're going to trade through the low. This is forming a bearish market structure, right? Because liquidity is getting taken out to the downside. It's retracing back to the area where it got taken out and then following that structure. So that's the first thing. The best way to understand that is looking at the highs and lows. If you just go to like a daily time frame or a higher time frame and you look at the highs and the lows, and mark it off with like a line, right? A horizontal line or array, you can see that is where liquidity is. If the price hasn't gone or traded above it, it hasn't done it yet, but eventually it will. So disproportion. Now, what is disproportion? Disproportion is what they call like the gaps, the fair value gaps, and things like that. Like those are terms. They're smart money concepts, ICT concepts, things like that. But I like to keep it simple. I've gone through those. I've been trading for like 10 years plus, so I've gone through every single type of like person's training you can go through. So I understand like you can make a lot of money from those concepts, but my goal with this is to simplify it way beyond like the technicals and things like that, right? So how do we explain disproportion or these gaps? Why do these gaps get created? These gaps are basically signals for the banks to come back in and get a better price, right? So let's just take this last example right here before I actually show you on the charts where it'll make sense. We have market structure, which consists of liquidity and disproportion. This market structure is showing liquidity at the highs being taken out. So what is disproportion? Disproportion is when the price trades through a high or a low and it leaves a gap in the market. And that gap is simply an area where the banks want to come in for a better price to buy before going up, right? So the market has a high, price gets taken out with a disproportionate candle or a disproportionate movement, meaning like it's going one way really strong and it breaks above a high or a low, in this case a high, and then you can see in that area where that gap is where the price will want to come back down and trade before going in the same direction, before going in the direction continuing. Same thing for on the downside. So I'll show you that in real life on the charts. Is literally that simple. The most difficult thing about it is being patient to wait for these things and then training your eye to see it over and over and over again. But here is an example. We'll start, and I'm on a monthly, so I'll get down to the daily and then wrap up this market review. So we can look for moves during London session, London session and New York session for tomorrow and the rest of the week. All right, now this is market structure, right? I'm starting down here. It's like 2011, 2012. You can see that price creates this high right here. It's been going down, obviously, right? And then it creates this high and it starts to trade a little bit lower. So I'm going to mark that off. Okay, boom. That is a high that got taken out with an engulfing candle. This is a disproportionate candle. This candle leaves a gap in the market after it broke above a high. From the top of this wick, the previous candle before the engulfing and the candle after the engulfing, the bottom of the wick is where the gap is. So I'm going to identify that and we're going to just look at how price plays within that gap. Okay. I'm on a higher time frame, so if I would have dropped down to like a daily time frame, then or a weekly or a daily time frame, then you would see this better. But this gap, all it did was break structure to the upside. This was a change of character, right? And then this was the break of structure to the upside. Because this broke the high with a body candle, left a gap or disproportion on the way up, and the market has to stay balanced. So it came back in to trade for a better price before going up. Now we can also grab fibs on this to identify how much or how far did it come down. Did it give us any type of discount to get in on this price? Yes, it did. Give me a second. Boom. Okay. We can see when the price shot up, breaking above this structure and creating this gap, and then it started coming down, it gave us a 50% discount, 60% discount, 70% discount, almost even an 80% discount before trading even higher to our TP1 and our TP2. So that's market structure. You can see the liquidity um, again got created at this high, which would have been our target. If we seen that this low down here didn't get broken, price just traded back into the zone for a better price and then shot up, and it created disproportion here. So we'll mark that off. Now I'll stop right there, liquidity and disproportion, but you can see the price didn't come back down there yet. It may in the future or it may not, but we just know that if it does, those would be targets that it would come back down to. Now let me just show you one more target or one more example of that before we look at moves for this week. Here was a high that was created because this was the last high price before the market traded down and then traded above it. So I'm gonna mark that off. It gets taken out right there. Whenever a high gets taken out or a low gets taken out, the algorithm is going to kick in because the average person is going to see this breakout and start buying, but they're not going to realize this high just got taken out. So the algorithm kicks in for the market makers to come in for a better price and trade higher or lower. In this case, we're trading up, so higher. But as you can see, this movement gets taken out with a disproportionate move in the market. Now let's look at this gap. And if I extend it, we can see how we could have caught an entry there. I mean, to the T. Like, this is the kind of stuff that you will look at and be like, yo, how the fuck did you catch that move, bro? Because people are waiting for these gaps to come and get filled, right? This price touched the gap a little bit, shot up, created disproportion, and then came back to retest in this exact area because they never really filled the gap up. You can see here they filled the gap up. And again, I'm on a monthly, so if I just drop down to the daily because I just want to show the example, you can see how, look at how the price plays in this gap. They shot up and they retested a little bit here, went a little higher, but look at how they came down and filled the gap up all the way, but never closed below this level, right? So that's a strong level, and you can see how every time they came to this level, there was a dramatic move. Every time they came to this level, there was a dramatic move. When they came to this level, even as much as right here, there was a dramatic move, and they don't go back down there. So, you when you start to look for liquidity and disproportion, just look for like highs and lows, and I'll give you like guys practice and stuff like that if you need it, like what to look for and stuff like that. And this is the last one, so we can look for moves. Right here is a high. Here is a high. Let's look at how this high gets taken out. It gets taken out with disproportion. So you see like majority all green candles. You got this little bearish candle, but majority all green candles. This is a gap in the market because it's doing a lot of one thing, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Almost 2 weeks this market was just going straight up. That's disproportion in the market. So the market may eventually come back down there at some point in time. But if not, it's going to keep going up. So moves for this week. I'm on a daily right now, and my bias is honestly still bullish. Why? Okay. Still bullish because this was a high here, and then a low was created here. So this was the low. This was the last low that was down here after this. Once they broke this structure area, they never went back lower than that. In this move right here, hold on, let me show you guys. Boom. This was a high. It got taken out again with a disproportionate candle, as we can see right here. That creates a gap in the market. We'll get back to that. But the move up, the way it happened or the way it started from right here, right? This went up and it came down, and when it came down right here, this move took out these highs. So this is a significant area. The price may not come back down there right now because it's obviously going up. The next thing we need to look at is this, right? Look at how this price came down with this engulfing candle, where the average person would just start selling because they see all of this, so they think it's going to keep going down. But the price just took out a low, so the algorithm is going to kick in where it trades back into where it broke that structure. And look at how many times it did that. Once, twice, 3, 4 opportunities for you to continue going in for the sell. You just want to do it at the right time. Don't do it after this move. When you see big moves like this is your signal or confirmation. This is the bank basically calling your phone and saying, yes, we are going to continue to go down, but wait for a better price to get back in. So once that happens, you can see, I'll draw this gap and then show you something. The price creates a gap right here. It creates a gap right there. Now, if you look into the future, what happens is the price tries to trade up, fails, tries to trade up, fails. And then once it finally trades above it, look at how high it goes, and it takes out these levels of liquidity right there. But then it falls back into the structure right below this low with a body close, and then it trades lower. But they only traded back into this gap. They didn't go any lower than that. And we were already bullish, so we can see they traded right back into that gap and then gave you a better price to go higher. Now, this is where the structure broke because it came down once, touched it, took it out, but didn't trade above it, came up again, didn't trade above it, and then finally they traded above it. So look at how when they traded above it, how they stay above it, right? Let me draw this zone out for you so we can see it more clear. Look at how the price trades up, engulfs below, multiple touches, rejecting or resistance, trades below, comes back up, resist at that price again. And then where it was resisting, once it finally broke through, that is where it retested to see if it was going to go back down, which is it's showing you it's not trying to go back down. So then they created highs here, and the move to take out these highs started right here. So they took out those highs, but they left gaps along the way going up, which you can see right here. And then look at how the price plays at that gap before going up to take out these highs. So all I'm doing is extending this gap that the market created because this is structure. The reason why it's structure is because the price is not doing this. The price is not coming to this level and doing this. It's doing the opposite. So I'm not looking for sells on this because it's not breaking below the structure. And that's how simple you got to keep it. Now, why am I bullish on this? Because it has not broken this structure yet. And I'm seeing the market starting to create higher highs and higher lows. For example, the market was coming down, obviously, retested and fell. On the way down, it created gaps, right here. My bad. Boom. It created that gap. So when it created that gap, it retested that gap, created like an order block here, and then fell. And then price traded above it, taking out the liquidity. The algorithm kicked in. They didn't fill the gap up all the way yet. Still room up there. Took out the liquidity here. Algorithm kicked in, traded back in for a better price for the market makers. Price went up, came back down, but none of these lows are getting taken out, right? Price traded up a little bit, came back down, traded higher, taking out this high, then retest back in here. And if I drop down to a smaller time frame, we could see a gap somewhere in here, which is why the price stopped like that. And now, if we're bullish on this, where would we expect the price to go? Like, where would be our targets? Well, this big ass green zone, like that's a monthly zone. I think we drew that off of the monthly, trying to identify something. So we know that this is a strong area. It's a lot of liquidity in this area. But immediately, we want to look at these highs. This is a high right here, and it's on the daily time frame. So top-down analysis, like I said, if you want to be surgical, you can start on the monthly and weekly. But for top-down day trading, we're going to start on the daily and identify our bias based on market structure. So prices, I'm seeing higher highs and higher lows, and I'm just marking off if it's going to continue to go up, where is it going to go? So I can see that those would be targets, and it's very close to those targets right now. But once I identify my bias, which is bullish, now I want to go down to the 1 hour, straight from the daily, straight to the 1 hour. So I can identify where liquidity is from day to day. All right, now looking at this on the 1 hour, I could see liquidity is right here above these highs. And then the price, there was this gap going to the downside on the 1 hour time frame. Right here, right here. And let's just change the color of that so we can know what it is. All right, boom. It drops down, and then price, you can see, goes and closes that gap, trades below it, takes out this level of liquidity, but stops right here where it broke before, where it broke the market structure. As we can see how price is just holding there. If they wanted to drop, they would have kept dropping, and then they trade higher, breaking this structure right here. Once they broke this structure right here, they're just retesting to get in at a better price before going up to take out these highs. So let me mark off where we're looking at this, and then we're going to come back at New York session in the morning and look at these moves and catch this money. But market structure is liquidity and disproportion. Liquidity sits at the highs and lows, and disproportion is the market trading through those levels with big candles. All right, so that's it. Oh wow, Bitcoin is definitely going up. It is above the level we started looking at it at. Gold is below the level we started looking at it at, and USD JPY is at the level that we started looking at it at. So I'm gonna take pictures, put these in the group chat or in the Discord, and I'm about to upload this video, and we gonna do some motherfucking happy trading this week. Let's get it. All we do is numbers. It's your boy Eddie One Take, trading for the trappers. Yeah.